Everybody, welcome to our Chapter 24 lecture. We're going to go ahead and go over performance measurement and responsibility accounting. Okay, it's not like who's responsible for doing the accounting stuff. It's more or less how we keep our management responsible and that they're going to make the right choices and how they act. So things like that, that's what we're going to be doing. Our first focus is going to be on how we're going to account and report on our controllable costs. What are controllable costs versus uncontrollable costs, etc. Okay. Larger companies, as you likely are aware, are broken up into several smaller units, and they've called them divisions, segments, departments, subsidiaries, whatever. Okay. You're not going to have one company with tons of different products all under the same corporate just stick structure. You're going to have this flow chart showing who's in charge of the general areas, and then so on down to who's in charge of each of the assembly lines and things like that. So we've got to understand that. We have three different centers that we need to make sure we understand what they are and what we're looking at when we're dealing with them. First of all, we have a cost center, all right? Their cost center is a center in which all they do is derive costs. They basically are there to support other divisions or segments or departments. So for example, a cost center might be an accounting department or an HR department. They're not really producing anything that's bringing in money, but they're necessary in order to keep the company going. A profit center is going to be it's going to have both costs and profits involved in their center. Okay, they're going to have they're the ones that, even though the cost center people think they're more important, the profit center people are actually the lifeblood of a company. And it's interesting, and I don't speak from, well, maybe I do a little bit. When I worked for a government entity, our administration, who was the cost center, thought that they were more important than those of us who were writing the reports and basically doing the work. Well, it was kind of a toxic environment. It was very challenging for them to understand that we don't take on more work as a profit center to make the cost center's life easy. In fact, it's quite the opposite. I also experienced this in the military. In the military, I was the convoy commander, and so I was in charge of several trucks and personnel. We had to get from point A to point B, hopefully without any incident. But our cooks, mechanics, supply people, oh boy, they thought they could just pull from the line platoons and use them to make their lives easier. And it really pissed me off because our commander would keep letting them do it. But the thing is that without the convoys and the trucks and us being there, they weren't there to support anybody. Okay. And that's the problem with these corporations. A lot of times people, and I'm an accountant. Listen, when I'm doing actual accounting work, I recognize that I am not there to make the profit center people work for me. I go there, I set up scheduled times that I need information. I'll get it from them when they're ready and available. Now, there are deadlines. You do have to work with them and try and make it happen on an expedited basis. But when you go in as an accountant with the idea that, hey, you recognize that you're there to support them, they're going to respect that, and they're going to be a lot easier to work with. So my recommendation is, when you become an accountant, whether that's a managerial accountant or not, respect the people in the profit centers. They're the ones making the money, and they're the ones that really run the show, even if everyone else thinks otherwise. Investment centers are the ones that are like if the profit centers are the lifeblood, the investment center is the I don't want to say blood bank. What would I say? It's what keeps the entity alive. Investment center are the people who are buying new equipment and making capital purchases. Maybe they're dealing with the research and development. They're trying to make it to where they're able to create investments and products for the future. All right. They make the major investment decisions and stuff like that. So Each of these three entities are all very different. Even though the investment center and the cost centers all just incur costs, they don't bring in any money or anything. They need to be able to be evaluated so that each area can be, I don't know how to say this, I guess, relevant, relevant for lack of better words. So cost centers need to be based on their actual costs and comparing that to their budgeted costs. If they're not able to control their costs, then there's a problem. They should be evaluated that way. Profit centers, how well are you in generating income? And then the investment centers is how well are the assets you're providing the profit centers generating income. Those are some good ways that we want to look at evaluating these. Now, there's some things that are controllable and some things that are not. Controllable costs managers can determine or influence. For example, maybe the manager shouldn't need to be buying so many supplies. Maybe they shouldn't be throwing so many parties or whatever. Uncontrollable costs are not within the manager's control or influence. For example, I'm willing to bet that a manager would want their own salary to be higher. So they don't influence that. It's someone higher than that person. Other ones might be the rent on the facility, depreciation expense, because they don't set policy on how to depreciate the assets. So those are some good examples of how costs would be uncontrollable. But a manager can control other things, like maybe instead of buying from this vendor, they buy from this vendor and it's cheaper. But then in that case, as we learned in the variances from chapter 23, maybe that's going to make their direct materials, maybe the price variance will be low, but the quantity variance will be high because the quality isn't as good. So those are some ideas. Here is an org chart showing you that you have a board of directors, then they elect or appoint the president, vice presidents of each area. And then within each area, you're going to have, in this situation, you have a plant manager on the western and then plant manager on the eastern, right? You could just as easily have three, west, central, eastern. You could have them broken up as much as you want. And then under each manager of each plant or area or whatever, maybe they only have two plants, but they have the manager over the beverage department, the food, and then the service. And then maybe the Eastern company has different products, whatever. They're over those three. So we need to go and we need to look and see which costs are under the influence or control of which managers. And that's what we want to identify. So when we look at our responsibility performance reports, the managers of each of these bottom departments, this beverage, food, and service departments, are all going to report to their plant manager. Okay, and they're going to be held accountable for their costs. So we see here all of the information here. We see our, what were we over and under. We see that, each of these, this is the beverage department, but we know that there's two other ones also. These get rolled up into the beverage department. Was those other two beverages? Beverage, food, and service. Okay, so I see what it's doing. We're looking at the beverage through the western plant up there to the vice president. Okay. So then this for this one gets rolled up, and for the plant manager as a whole looks at the beverage department. Now you have one for the food that goes to food and one in the service, and then you have these other, insurance, rent, salaries for these managers down here, and then those get rolled up into the overall budget in the Western faculty. I did it again. Western factory. And whether or not they're over and under. So we move it on up. So you see each one of these is going to influence. Now the service department didn't do very good, but the food service knocked it out of the park. And the food service is probably going to do really well as far as their performance, their bonuses, things like that they might get. This is kind of how it would work. And then the vice president's going to report that their area had a $5,900 they were under budget. Oh, I'm sorry, over. I was reading that wrong. They budgeted, but they were over. So this over is not good. Oh, my apologies. So under budget's good, over budget bad, over budget not so bad. Under budget, good job, service department. I take it back. So I was reading it wrong. But anyway, that's kind of what we want to look at. We want to see, hey, how is everyone doing? How are we over, under? We want to look and see. These managers are going to look here. Direct labor and utilities were good, but what happened to our direct materials? What happened there? And then they're going to look at the direct materials price and quantity variance and try to figure out what happened, see what they can do to fix that. This plant manager is going to look at all of these things and see here, look, we were over budget on our salaries for our managers. What happened? Well, we gave our service department manager a raise, and so they had a hire here, but they brought it to where they were under budget. On food service departments, these other people, you look to where you can control the costs. Rent, I know it's listed under controllable costs, but if you have a plant factory in the Western United States, the odds of being able to move that plant somewhere else are going to be very small. So if you've got a building rent, fine. But what I would probably see here more than likely is going to be depreciation expense. And you still can't change that one either, okay? Because that's a policy based on generally accepted accounting principles. And then over here, the Western faculty, they're going to look and see they're going to look here and see that this Vice President of the United States, they're going to look and see what the heck, Western factory, you guys are my bane. We got to figure something out here. And they're going to come down here, try and fix here, and this guy's going to try and fix the other three managers. So that's kind of how that works. That's what we're looking at when we're doing that. Now, what happens, though, is we're dealing with these profit centers, but we have these cost centers that are incurring costs. We have to allocate those costs to other departments because we can't just say, well, we have these costs, but we're not going to pay them, so we're not going to, allocate them. So what's going to happen is we're going to take our direct and indirect costs and we're going to allocate them. Direct costs will be directly allocated to each of the areas in which they're traced to. So, for example, if I am the plant manager, like we were talking about, our direct materials to the food service, our direct materials to the so we have the food, the beverage, and the service. Each of the direct materials that are going to them and doing what they got to do, that's allocated. That's really easy. But what happens is that you have this accounting department over at headquarters. You have this HR department at headquarters. They're also going to send us costs based on some kind of level of measure. And we'll get into each one of those in a minute. So direct costs are directly traced to what they're doing, but then these indirect costs are from these other departments that really don't support a product, and then they're going to be allocated to these ones. And I did deal a lot with allocation of costs and looking at that. There was one company I dealt a little bit with who would create 7 layers of allocations. It was a nightmare trying to audit them. I hated them. So anyway, let's look at this. If we have indirect expenses, we're looking at supervisor salaries or whatever. We may look at the number of employees in each of the departments and allocate. So if I'm the plant manager and I need to allocate my costs to all of the line items of the people who are working on the products, I'm going to count the number of employees of each of those departments, total them up, and then take the number of employees in the food service or the food department, divide it by the total, and then take my salary and multiply it by that ratio. Same thing with the beverage, same thing with the service. I'm going to allocate it that way. Rent and utilities, it's a good thing to do is just say, hey, rent and utilities typically is based on square footage. The more square foot you have, the more rent and utilities you're going to use, more than likely. Advertising can be done based on a percent of total sales, and insurance could be the value of the insured assets. Another thing that could be done by a number of employees in each department would be HR. Accounting could be done on various different ways depending on who or how they felt like those things should be done. If for some reason there's one area that has their devoted HR person or whatever, then obviously those could be traced directly to that department. So this example is a jewelry repair and clothing department. So retail store pays an outside company to come in and clean it. So what's a good way to debate on how to allocate these costs? Well, the more area they have to clean, the more cost it's going to be. So for the departments that have a higher square footage, it's going to take that cleaning crew longer to clean their areas. So we can rationally say we can base that on square footage. So when we come over here, we're going to add up all of the square footage to get a total of 4,000 square feet. Then we're going to take our jewelry department's 24,000 and divide it by 2,400 divided by 4,000 to get us 60%. The repair section is 600 square feet divided by 4,000. Clothes 1,000 divided by 4,000. So those are going to give us those percentages you see there in the second column, 60, 15, and 25. Then we're going to take that $800 and we're going to multiply it by 60%. It's going to give us $480. That's going to be allocated to the jewelry department. 800 times 15%, it's going to give us 120. That's going to the repairs. And then to the clothing department, 800 times 25% is $200. So that's how we allocate it based on whatever driver we're looking at. And that can be done by a ton of different ways. So please make sure that you understand that. All right, departmental income statements, it's basically going to reflect similar to what a departmental income is going to be. You're going to have your department sales minus your direct expenses, minus your allocated indirect expenses, minus allocated service department expenses is equal to your departmental net income. Basically, it's net sales minus your costs, your expenses, indirect and direct, regardless of what they are. That's going to be your net income. Then that gets rolled up into the bigger picture, and then on the financial statements of the company, you'll see how it works. So our expenses here, first of all, we have our sales and then our cost of goods sold. Sales per each one, and then we have our cost of goods sold allocated based on whatever we sold out of those areas. Then we're going to have salaries and depreciation of the equipment that are direct expenses. We can directly allocate these specifically to each of these areas, okay? Now, we have purchasing department, though. That's a service department. They're the ones that purchase things for these two departments so that they can do their work. So we have a total of $41,300. So we've got to allocate this this $15,000 for the purchasing and this $2,000 for the depreciation. Then we have these indirect expenses for 13,000. Oh, you know what? They might be just calling this service department its own, and then we're going to allocate it. Although I think that would be really weird unless they're doing some kind of work. But with its purchasing, it should be purchasing for these two organizations. Let's look and see what they do. Indirect expenses, this 12,400. These 4,000 need to be allocated as well. All right, so we're looking first at rent, $12,000. We're going to allocate it to the purchasing, hiking, and camping. So it looks like we are allocating it based on that. The advertising is going to be based on, we're not advertising for the purchasing department, so they're not going to receive any of this allocation. The hiking and camping only are going to get it, and so they're going to be allocated based on their total sales, because that's what advertising is, and then getting our percentages, so 60% is 4,000, 40% is 4. The idea is that whatever advertising was done is more than likely going to help the people having the most sales, because getting them in there from the advertising is going to drive those sales. And then we're going to allocate, here's where we're allocating the purchase orders, okay, the purchase department. So we have a total purchase order costs here of $1,200. So we're allocating that. Oops, sorry. So even though we allocated some of the rent here, we're still going to allocate this over here to the hiking and camping. So they just did it in 2 steps. I was thinking of doing it in 1. That's fine, because I guess purchasing needs to have some of the rent, because that's technically their costs, and then those are going to be allocated to the other ones using the different drivers, which were purchase orders. So the hiking department had 840 purchase orders, meaning they're using the purchasing department more, so they're going to get a higher chunk of their expenses since they're making them work more. And camping's going to use less, so they're going to get less allocated to them. Ultimately, we have 60,000 expenses to account for. If we come over here and we take this 34,200 and we add that 25,800, we have that 60,000. That's what we want to make sure. These two add up to that 60,000. These are going to be added to with all these two plus the bottom ones here. Let's see, purchasing. We want to make sure that these two that these all equal the expense that was allocated, these two equal the expense that was allocated, and then these two equal the expense that was allocated. If you make sure all those numbers tie, you probably did it right. Let me give you your word right now, just so that those of you who are just going to the end will have to really come back a lot earlier now. So this is chapter 24. Our word today is heritage, 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 Hotel Echo Romeo India Tango Alpha Golf Echo, Heritage, heritage. Okay. And let's see. Yeah, so that was basically it for this slide. So our income statements are going to look like this. We're going to show our sales, cost of goods sold, gross profit, expenses, and income or loss. Now, in chapter 25, we're going to look at this and we're going to ask, hey, should we get rid of the camping department? Look, they had a $5,000 loss. What's going to happen if we get rid of our camping department? And we'll get into that in chapter 25. I don't want to like make you start thinking about it now, but that's what we're going to be looking at as we see the loss. What would happen if we got rid of them, and how would that work? So we'll go over that at that time. Departmental contribution to overhead. I guess we are going to do it now. So even though our camping department had a loss, it still contributed to the overhead. So we had $8,420 of an income in our camping department that was still there before we allocated our indirect expenses. So it still contributed to the overall net income of the company. It wasn't an overall loss for that. It wasn't until we allocated the indirect costs that the camping department experienced that loss. So we want to make sure we don't cut our nose to spite our face. I don't even know what that means. Cut our nose to. Oh, if we cut off our nose, it's gonna hurt, and we're not gonna have a nose to spite our face because our face is ugly or we don't like our face or something. I guess I don't know. Weird sayings that we have in this world, right? Investment centers using return on investments and residual income. Okay, these are some areas we could look at. We're looking at an LCD and our phone. These people have invested various operating assets into these two departments to derive income. So what we're going to do is we're going to take our income and we're going to divide it by our average assets. And we see that our LCD division got a 30% return and our phone was a 20% return on our investments. So we could compare those. We can look and see how that is and compare that as far as our how well they did before and give bonuses based on that. We can also look at residual income. Residual income is income minus our target income. It's basically saying, hey, how much money do we get extra above and beyond what we wanted to get? So if we had residual income, target is 8% of average assets. So our residual income for the LCD needs to be $550,000. And that was less. I'm sorry, our residual income is $550,000. Our phone was $222,000. So both departments did very well and was able to achieve not only that target, but also the residual income. So definitely some things to be considering as far as bonusing those companies. Investment centers using profit margin and investment turnover. Again, this is another way to do it. Analyze our investment, or our investment centers. Our ROI is our profit margin times our investment turnover, or our income over sales times our sales divided by average assets, or basically income divided by average assets. That'll get you the same thing. So here we go. We're going to look at this. Our profit margin on our LCD was 8%, and on our phones was 5%. So our LCD did better, but on our investment turnover, LCD was slightly below the phone department, and those are the things we got to consider and look at. So looks like to me both of them are pretty good. But what happens if we're only focused on looking at the amount of income we got? What's going to happen, or what could happen? What could happen is you could have a manager who's all of a sudden saying, hey, if all we're looking at is the bottom line, well, I know how to fudge the numbers and make them look better to get me a better bonus. So what looking at only money does is it actually makes it to where um, fraud could occur, misappropriation of assets, other things like that, making things look better than they really are. So we want to avoid that. And so what has come about as a result is using something called the balanced scorecard. Instead of solely bonusing or giving incentives to managers based on their financial performance, we're going to look at other things as well. For example, if we're just looking at the bottom line, I could be a manager and I could say, hey, we're going to buy the cheapest crap and pay the cheapest labor, and we're going to come in under budget every time. And while that may be true, what's going to happen to our product? It's going to be crappy. Okay, our customers are going to hate it. We're going to lose sales. Things are going to be a problem if that's what I do. So we want to look at that. Hey, look at our customer satisfaction rating. How many new customers have we had? All these things could be important for the manager, even if they're just building the product. So some things could be also the number of defects. If you have too many defects, or excuse me, maybe it's how many you've seen Monsters Inc. where they had number of what was it, emergency days or accident free days or something like. Oh, there it is. It's right here on the slide. Accident free days. Yeah, warranty claims. That kind of ties to defect rates. Things like that. Those can be definitely impactful as far as a manager's desire. If I'm getting partially evaluated on the financial, great, but I'm also being graded on whether or not I have a bunch of defects. So I want to make sure that I'm still paying for good quality products and making sure my employees are doing it right. Because even though I may not make my financial goals, if I still make my defect goals and my product cost goals, then I'm okay, and I'll still get a bonus. Innovation and learning, maybe dollars spent in training, employee turnover, things like that. There are some companies that have found that it is cheaper to have some employees quit and to just get a new employee and retrain them than it would be to give that employee who's asking for a raise. And so you'll go to a lot of these places and you'll ask. That should be one of the things you're asking. What's the average years employed by this company? What's the average employee years with the company? And if they're like, oh yeah, 30 days, run. Okay, don't take the job. I don't care how desperate you are. If they say like 17 years, that's a company you might want to stick around with. Okay, they may have some perks and things. On the other hand, you may not get promoted very fast too, because if people aren't leaving, then that could be a problem or consideration too. But the point is, those are some concerns and things you want to ask. How's the employee turnover? I worked for a place, they didn't care. You could be God's gift to auditing, and if you had an offer from somewhere else, and there was someone too that say, hey, I like working here. Just meet their offer and I'll stay. And they're like, no, we'll get someone else. And I was there too long. I really left, and it was nice, but I liked working there in the area I worked in. And then a manager. It was when I was working in the fraud area, and I loved working fraud. Oh, but my manager was a pain in the ass. Oh man, did I not like her. Anyway, and I usually actually I had like 90% of my managers have been female, and I have loved almost everyone except for that one. And she was one of those micromanagers, okay? And I hate being micromanaged. I can think. In fact, I finally got a button or something I hung up in my office area, and it says I have permission to think, just because she just had to be controlling everything, and it just drove me nuts. So anyway. All right, transfer pricing. I'm just going to go over this kind of briefly, okay? And this isn't something that's like you've got to absolutely have hard, Pat, you will have some problems and stuff probably on this. But I just want you to make sure that you understand these concepts. Transfer pricing is if I'm a manager of one department and I have a sister department both within the same company, that makes a part that I need to finish and make my product, unless there's a policy that says I have to use them, I'm still gonna want, if I'm, especially if I'm bonused on financial goals, I'm gonna want the best, least expensive product I can find. So when I go out to the market, this person at the top up here says I won't pay more than $80 market price to buy this LCD screen. Okay, so they're looking for anything below $80. Well, the manager down here and the LCD manager says, hey, I sell it less than 30 bucks. I don't make money. So I got to have it more than this. Well, the LCD manager doesn't want it at 30. That's where they break even. And they don't want it at $80 because then they could probably go work with someone that's a lot nicer or something, maybe, I don't know, on the outside, who's going to, take him to lunch every now and again or whatever and stuff to keep him buying from them. So they got to find some price that's best for both. And it doesn't always mean right in the middle, okay? Sometimes it might be over here. Sometimes it might be closer to market price. Because this manager, while this is looking at it from one perspective, it's looking from at his perspective. Her perspective could be also, hey, I can, not only does $30 per unit cause anything less than that causes me less to incur a loss, but hey, the market price is $80. I can go out and sell it for $80, and I don't sell it to you. I'll sell it on the market, and people will buy it from me. So they got to come to a agreement on where it needs to be at, and there's no hard, fast rule on how to do that. Okay. Because if he comes back and says, hey, I want to split it down the middle, she's like, no, $80 I can go sell this on the market for, and I can get $80, and I want it. I want that 80 bucks. So he might say, look, you sell for 80 bucks. If they have problems, it's going to be this issue. But if it's with me, it's internal. We can work this out. It'll be beneficial to you, beneficial to me. How about we go 70 bucks, 65 bucks, somewhere in there. And then all of a sudden she's like, I can take a couple dollars hits knowing that relationship is built and it's internal. And so that could work. So there's a give and take that these two managers need to be in. Truthfully, she's in the driver's seat. If she knows what she's doing, she's going to, I don't want to say win, but she'll make out better than this guy will. But at the same time, he's getting it for a cheaper price than all of his other competitors are. So, it is a win-win. So just someone's winning probably more than the other. Anyway, so they said transfer price. And this is if there's no excess capacity, then their argument would be that the LCD manager will not accept a transfer price of less than $80 because they could go sell it for 80 bucks. If they're like, hey, we're operating at full capacity, I can get this for 80 bucks. That's all we're doing. Then the phone manager is kind of out to dry. But if there is capacity, that's when they can really say, hey, you're not even using the full capacity. This can add money to your division instead. And yes, instead of making $50 a unit, you still be making $40, $30 per unit. You're going to help me out and stuff like that. Then you can start negotiating it, and that works. So transfer pricing, it's an art, not a fast rule, but you just got to understand these concepts to know how to debate with the other person and to come to an agreement. But if you're the phone department and the LCD division is operating at capacity, they have you. If they're not operating at capacity, then you can work with them, at least to the degree to where they're up to operating at full capacity again. At that point, you may not be able to buy all of your products from them. You may still have to go out to market to get some of them. So, all right, well, that's it. That's the end of chapter 24. Please make sure you put that word in the video, in the video verification assignment. And if you have any questions, please reach out early and often, okay? Make sure you're still coming out and talking to me about it, okay? Anyway, have a good one. We'll see you guys in the future videos, and take care.